Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us and Happy New Year. This is our first show back for 2026, and I hope we can get it right like we did last year. I think we had a pretty good year of picking good quality companies, which is always the process that I endorse. Quality companies, believe in them and buy them at the right time, just hang in there and wait for them to become good. And today we're going to be talking to Adam Dawes of Shaw and Partners. I'm going to run past him a number of stocks, great quality stocks have been smashed at the moment, and ask him the question, does he think it's the buying time for these stocks? CSL, NextDC, Xero, Medicus, all the ones that have been great performers now being smashed. I then will get Mike Gable from Fairmont Equities to look at the charts, to see if the charts are offering anything positive. Mike will also look at the things that he thinks are looking positive, but we'll get another take from the point of view of a chartist. And finally, Paul Rickard will join me from the Switzer Report. He wants to look at gold, the best way of buying gold, what's going to happen to gold, and is there still more upside? That's the show. Let's now kick off with Adam Dawes of Shaw and Partners. Adam Dawes, thanks for joining us.
It's great to be here, Peter, and happy 2026.
Yeah. I tell you what, it is a new year when I see you with a Kevin Rudd beard, mate. That's a new approach by Adam Dawes.
I don't know. I'm just I'm trying it out. I'll see what the viewers think and get a straw poll, and then we'll work out what we're going to do with it.
You'll probably look really cool in a nightclub on the weekend, mate. But I don't think your wife will let you go near a nightclub anyway. Or your kids. But the bottom line is this. I want to run through a whole lot of quality companies that have been beaten up and see whether you think over the course of this year, because I'm not expecting a lot of these companies to have a positive response, but their share prices are at such attractive levels on my reckoning. I want to know what you and your colleagues at Shaw and Partners are thinking about this company. So let's care for the first one, CSL.
Well, yeah, look, I think overall it's certainly been beaten down. It's certainly a quality company. I think management really need to give some more confidence back to the stock and back to the market.
Yeah.
It seems to have found a little bit of a base here, so I'm okay with it down here. I've actually been suggesting for clients just to top up a little bit more or average down, as it were. So look, I think it's okay. Quality company's good. It needs management to really secure and get the confidence back. But overall, look, CSL is a blue chip, so it should be okay.
Yeah, you feel it's in the buy zone. And the point I made, I don't necessarily think we'll see the gains unless February 10, when they report, is better than expected. Then we'll see a big spike. But I just think it's such a low level now. It looks like a good buy zone for someone who's never ever had CSL. Tick.
Yes.
And for people who have maybe got in at 200 or 250, it's a dollar cost average prospect, isn't it? Really?
Yeah, and I think February 10th, as you say, is going to be that day that is really going to sort of either cement CSL and then give confidence back, or if hopefully there's not another downgrade, but if there is, then obviously the market will readjust. But yeah, that's a good inflection point to be looking for.
If there's another downgrade, Paul McNamee's brother, the chairman, Brian McNamee, he won't last.
No.
I think I might even show up and tell him to, pack his tennis bag and go and play doubles with his brother. Anyway,
Yeah.
so his history's been great until recent times. I should throw it down as well. He's been a good performer. NextDC.
Again, it's just, you're right. There's so much value at the moment. I mean, obviously the resources have done really, really well. So, it seems like it's a market of two halves. The tech stocks, and I suspect we're going to talk about a couple more tech stocks in this value show. Look, I think overall NextDC is going to continue to do well. We know that they're releasing another land packages, and the New South Wales government is looking to help them, fast track some of that stuff. They are going overseas as well. They are looking to put other data centers around the world. Look, there's stiff competition. Goodman Group, there's stiff competition with Google, Amazon. There's a lot of competition out there. But I think NextDC is as a good Aussie data center provider. Really comfortable with it, and I'd be comfortable to be buying some at these levels.
And I like Goodman Group as well. But I know history has shown me that if you're going to buy a company with a few competitors, buying the best usually works out. It worked out with Telstra. It worked out with the Alliance Qantas. Yeah, whether you like them or not, the best and Commonwealth Bank in the banking sector is works out. Let's go to Xero now.
Yeah, well, look, this is probably the best in our market as far as for accountancy and work. I know I've got it myself, and I think I started at about $50 a month, and now I'm about $90 a month. And I don't even blink because it's so ingrained into our
It's
system.
beautiful, isn't it? It's beautiful. It's saying, yeah, it's
Yeah, some of those ads I don't really understand. I was over the holidays looking at some of these Xero ads, and I'm like, I've got a lot of money in this, but I really don't understand these ads. So anyway, look, I think overall they really need to prove their American strategy. They really need to show investors on how that is going to move and how they're going to take market share. And at the moment, that's not happening. We're not seeing that, and so potentially it's getting caught up with this tech sell-off, which is sold off and rebounded and now being sold off again. So I think it needs to make the market aware of that US strategy and how that's progressing. And if they've got some runs on the board, they need to really crow from the rooftops on that one.
okay. This is not an easy one because the personalities are interesting. WiseTech.
So look, you can actually separate it quite clearly.
You've had Richard turn up to your operation and woo you. You were wooed by Richard.
Yeah, absolutely. He's fantastic in what he does and the business, and they are moving into freight as well as they're moving into the governments. They're actually doing a trial with the New Zealand government. I think I said this last time. A trial with the New Zealand government for logistics. Now, if they can get that right, governments are going to start, wanting this stock. Now, we've got to separate what's happening from, say, potential insider trading from Richard, from the board, as well as then what's happening for the business. Now, the business hasn't really been firing because everybody's been concentrating on what's happening with the other side of the management side. So, look, getting them together, I think WiseTech is a very good business, and if they can continue, which they will, to tick some of these boxes along the way, I think it's one of our best logistics stocks on the market.
Okay, let's go to Medicus, one of our best health tech stock.
Yeah, have you seen 40x after PME got in at 28 cents? The stock's now $5.50 or something like that. Crazy. So PME.
Medicus, you should say Medicus, right?
Medicus, yes. Look, I think overall I'm comfortable with it. It has had a very good run. I don't know. Is there value here, Peter? I mean, what did it get up to? It got up to even 300 or something, didn't it? And now it's back. Yeah, I'd be cautious on this one. I just think that there's a lot of people with a lot of profit in this one, so it could potentially continue to fall. But overall, business is very, very good. Comfortable with management. I'd probably just stick that one on a bit of a hold and wait and see. I just got a feeling that might have some further selling in it.
Okay, PLS. Now we know it's had a fantastic run. We kind of liked it when no one liked it, but we didn't expect it to have such a big rebound. Is it sort of wait now, or can it go higher from here?
Look, I always said the lithium story was a 2026 story. It probably beat me by a couple of months as far as the movement that it's had. I think overall the lithium story is going to continue to do quite well. And I think the demand is increasing and the supply has been curtailed and they're starting to work out prices. So I haven't checked the shorts on PLS in the last coming couple of weeks, but they would be covering they would have been covering for the last 2 months to get out of this thing. So look, I think it can continue to go well. I like IGO a little bit better because it's got some nickel in there as well. And we've seen the nickel price starting to get out of the doldrums and starting to move again as well. So, yeah, PLS happy with it. Very, very good business. Lots of cash. I prefer IGO just on that nickel exposure as well, just to get a little bit more leverage around the couple of their commodities that they hold.
Well, we just got on screen at the moment the short list which we put out in the Switzer Report on Saturday, and PLS right at the very bottom. We thought it was off there. It's Yeah, that they are reducing their exposure
Yeah,
for sure.
they would have been. Yeah, they would have been madly covering for the last 2 months. So yeah.
Yeah. So it's probably a reasonable sign it can track higher, but it's not going to surge like it has. Uh, this is an interesting one. Now I'll go to uranium next. Sexy type stock. It's had a bit of a rebound. Paladin.
It's had a very good rebound, hasn't it? And next gen as well. That both of those have had some fantastic moves to the upside. Look, really, really supportive of the uranium story this year. What I would like to see though is the uranium price starting to tick up a little bit. It's been sort of sitting around that 75, 80 a pound for a while now, while all of the other stocks have gone boom, 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 right? So you need that commodity to keep following it, keep moving up, so that the share price is a justification for where the share prices are. So yeah, a little bit. I mean, look, it's been overall. I think uranium is a very good commodity for 2026. Very happy with it. Paladin's got a long way to go. Next gen's, sort of in the blue sky area at the moment, but Paladin's still got a long way to go, and I think that's why it's really marching higher. But I really want to see that commodity price start to support those share prices. And if it doesn't, then we will see some consolidation in the sector to reflect that commodity price.
Yeah, it's interesting. Looking at the biggest shortest stocks, Boss Energy is the biggest, with 19.4. Domino's Pizza 17.5. Guzman and Gomez 13.74, and Paladin 12.48. So if uranium has a good 2026, the shorters might be squeezed out. The price might go up, but still a trickier one. Now let's go for a really boring stock that's and which I never liked until the share price fell. That's Amcor. Well, we got a view on Amcor?
Yeah, so Amcor was just done a 1 for 5 consolidation, 1 for 6. I think 1 for 5, I think it is.
That's fine.
1 for 5. Thanks, Luke. So 1 for 5 consolidation for Amcor. Now, why did they do this? Basically, Amcor's share price was too low in the US market. And remember, it's a CDI, so it's an Australian business, but most of its trading gets done on the New York Stock Exchange or the Dow or the New York Stock Exchange. So what we needed to do is we needed to get that share price higher so it looks better from an institutional American point of view, or from America. So what they've done is they've done that consolidation. The stock has continued to fall on the back of this consolidation. Now, if you bought it today, you remember that it's not going to go. You're not going to have to pay for it until the 27th of this 27th of Jan. And if you sold it today, you're not going to get your money till the 27th of Jan because it's on a deferred settlement basis. So just be a little bit careful and make sure you check your holdings, because I've had clients ring up and go, "Oh, I've lost all these shares. What's going on?" And I'm like, "Well, you didn't. It's just been this consolidation." So overall, I think Amcor.
So you're saying if you've got 20 AMCs, you'll end up having 4.
4, correct. Yeah, 1 for 5.
A much higher value.
Correct. It's about $60-something at the moment, where it was traditionally trading around 20s, sort of around there. So, so it needs to, I guess, get some more confidence in the US and on the insto side of things. So I think Amcor is a fantastic business, great defensiveness, but just been caught up in this deferred settlement, which has sort of unnerved the market a little bit.
One last one. Gold. Are you buying gold as a defensive play, or are you buying it for a growth play, or you're buying it for both defense and growth simultaneously?
I think it's both at the moment. I've always said, as long as Trump's in power, gold is going to stay high, and we're nowhere near getting rid of him at all. So really comfortable staying in gold. Lots of talk about silver at the moment. Been buying some silver ETFs as well, sort of that basket. And I've been buying the gold miners, the GDX, which is the global gold miners ETF as well, not just the commodity. I've been going for the global ones. But look, I still think that there's some room left in the shiny metal to keep on moving. So gold, happy to hold and happy to be chipping away at it at the moment.
Yeah, and Paul Rickard makes a point, it's a pretty good point, that we probably should be looking at a hedged version of, I'm not sure if GDX is hedged, but there is at least 1 or 2 gold ETFs that come with a hedge, because given the fact I do think US dollar falls and $8 rises, it's probably going to be a good play.
Yeah, as well as interest rate rises this February coming up. So that will definitely move the currency also.
In Australia, you think interest rates will go up?
Yeah.
Okay, well, I hope you're wrong. I think January 28th CPI will determine it. But remember this,
Yes.
when the AFR did the survey of 38 economists, I think it was 16 were saying interest rates on hold.
Right.
And
So
nine thought it would fall. So it ended up being something like 25 not saying rates will rise.
right.
And that's still
Well, I will deliver a coffee to your office if we don't get a rate rise, but I reckon they will. So you're going to get a coffee.
and make it a big one.
Of course. Of course.
All right, mate. Thanks for joining us.
Great to be here. Thank you.
That's Adam Dawes of Shaw and Partners. Next up is Mike Gable of Fairmont Equities. Mike, thanks for joining us.
Thank you.
Okay, let's start, as we always do, look at the key indexes. S&P 500, obviously important. Our market always takes the lead from S&P 500. What's it telling you?
Look, it's still in an uptrend, but it is slowing down. It is stalling here. As for those who look under the hood, as the Americans say, there's there is a bit of weakness in the major tech stock.
Yeah, I've been going.
There does seem to be a bit of rotation going on. So in terms of the broader index, look, it's been pretty much sideways since September, October. A couple of lines I have here. This is the 50-day moving average. So as we could see, since the shenanigans back in April, it dipped.
The tariff, I think, the tariff shenanigans.
Yes, yep, right. It spent most of its time above the 50-day, but it has breached it on a few occasions. So
a bit of weakness period, wasn't it, mate?
yeah. So a bit of weakness. For those who are bearish, they might point to some similarities to the start of last year, where the market also was stalling. It was breaching the 50-day on a few occasions, and then it all let go in March and April. But for the moment, you'd have to say there's still an uptrend.
And all the analysts have a reasonably positive view on US stocks this year.
Yeah.
And we are only, 3.5 years into this bull market. They usually run 4.5 on average. And I think there's a lot of unusual things that could push this up a longer rally. Yeah. Donald Trump being one of those unusual things. Let's go to, you want to look at the Russell. And we don't look at Russell very often. It's a small cap index. It's been doing well, hasn't it?
Yeah, that's right. So sort of picking up from what I was just saying about the S&P 500, where the major tech stocks have been coming off a bit. That money seems to be flowing into the small cap stocks. So the Russell 2000, basically small cap stocks in the US. And as we could see, that's staged a fairly nice breakout. So now that's starting to move. So, and that explains, I think, why the S&P 500 isn't falling at a great deal of knots, while your Nvidias and your other tech stocks are pulling back, because I do think, well, it's pretty obvious that money is flowing into smaller parts.
The rally is broadening. It's broadening. More companies are actually, and we're going to see it here too, I think, particularly if we don't see rate rises, and that's another issue again. But let's go to the local one, the ASX 200.
Yeah, so not really too much to add, apart from, after that initial sort of scare in November, our market has been trending nicely. Several weeks.
January.
Yeah, and I think that a lot of that is, of course, because of the resources sector being a large component of our market, which I've touched on before. But look, steady as she goes, our market looks like it wants to just continue edging higher.
Yep. Okay. Let's go look at some individual stocks, and these are ones I've sort of focused. Like, I talked to Adam Dawes earlier in the program about some stocks that are great quality stocks, really beaten up. And I guess what I said for you, are we seeing a turning point for these? So let's keep CSL.
Yeah, look, CSL. So it is one I've looked at on a few occasions, and this is a weekly chart, so we could see that up until recently, for the last 4 or 5 years, it had been range bound. Good buy on the dips and a sell up here. Look, it is one that that I did get back into about 6 months ago. But unfortunately, I got burnt, and I think last time I was on the show.
It's unusual for you. You don't get burnt very often, but still, you're human. You're human.
Yeah, so look, it is one that we took our medicine and sold out of a few months ago. We could see that it did break down from that major support level. It tried to rally and retest. So it tried to get back above that blue line, but it failed to do so. So look, it is in a downtrend now. I don't know how low it can go, but it is looking negative. But
Yeah.
it's on negative.
February 10 is going to be important. That's reports. And if they don't come up with something positive, you're probably going to be right.
Yeah, I mean, the last time we heard from them, they didn't really have a handle on what was happening in the US with the vaccine business. So they need a bit more clarity. That's
Exactly right. Let's go to NextDC, another great company, been clobbered of late. What are you seeing there?
Yeah, so look, all the tech related stocks are going to look fairly similar. So yeah, we had that fantastic bounce and opportunity off those April lows, but since the middle of last year, just no love for this sector. So it is trending lower. I don't see any major support coming in yet. Yeah, really not much to add. I mean, it could find some support if it gets near that April low, near $10, but there is a downtrend at the moment.
Okay, let's go to another one, Xero, and it's even looking worse than NextDC. And I love the company. I think they look like in a good buying zone, but at the moment, you're not giving me any confidence that it's time to move.
Yeah, that's right. And yeah, look, I'll start out with saying that I think Xero is a great company, and it's a very sticky business. The way they acquire their customers. I'm a customer of Xero, and I've received so many price increases over the years. I
Doors, exactly.
I'm stuck in it, but obviously it's now a question of price, and I think the market's just moved into a different phase over the past 6 months where nothing's changed with the business, but the market doesn't want to pay those multiples at the moment. So we could spend all day questioning why that is, but the fact is the market is not interested in paying these sorts of multiples anymore. That will change at some point. Yeah, look,
And I've got to say, all the analysts love the company. Yeah. I think you've got the consensus view on Xero. There's a 90% upside, but it is what it is. They'll buy, and they'd be rather chasing resources right now than taking a gamble on tech.
That's right. And look, it's on my watch list. I'll buy it at some point. I don't know if that will be next month or next year. It's in a downtrend.
You got to gamble whether you buy it before the report, or if you wait for after, you might miss out, or you might get a lower price. It's a real gamble time, isn't it?
Yeah.
Let's go to WiseTech. That's a really easy one.
I think same story.
There's a different key person.
Yeah, not looking good. Still in a downtrend. Sorry to be negative, but I do have some crackers later, so don't go anywhere. Don't go.
As you know, I always try and deal with what I know, like from Boom Doom Zoom. People ask these questions.
Yeah.
And by the way, it's like a year or so ago, I was begging for you to tell me good news about BHP, and for a while there, it wasn't there. Then one day you came, and you were very strong on resources. You got it right. And it can be like that. The good stocks can be out of favor with the market.
Yeah.
For no other good reason. The market wants to buy, wanted to buy CBA then, up to $190. So we could see a change of sentiment, particularly if reporting season surprises on the upside. That's why I'm happy to talk about. Let's do it. Medicus. Great company.
Yeah.
Same sort of story.
Oh, look, I mean, this was our best performer in 2024,
Yeah.
Holding it during there, getting out, buying back in, and you feel like a genius. But again, market's not interested. So the PE, we've gone through a period where the market we don't care about valuations as long as they're growing their business and there's momentum, and that's what's important. And I'm happy to go for the ride. But now the market does care. Okay, it's gone from a PE of 100 something to maybe 90 something.
Yeah.
I'll have to have a look at the numbers, but that's still too much. Rightly or wrongly, that's what the market's doing. I think it will mean revert, which means this was the trend before the vertical move, the parabolic move. And if you have a look at, whether it's stocks or commodities, anything that moves parabolically tends to come back to the long-term trend. And if that's the long-term trend for Medicus, it could be a bit more pain ahead. So again, on my watch list, we're in, if we look back several months ago, we were in Medicus and WiseTech and all of these stocks. But again, we've rotated into resources. And I look at the portfolios now and it's a lot of resources, but that's what's working at the moment. At some point,
It's brand is your friend
that's
and
right.
the Benz, isn't it?
Yeah.
Let's go to on that subject then. Let's go gold.
Yep. So now we're talking volume. So yeah, I'm still a big fan of gold.
Yeah.
Since the breakout in, I think it was March 2024 when we first started looking at it. Doing really well. Now, what I've done here is I've gone back, and what is that, 50 years? And I've converted the scale to a log scale. So that way, each of these moves is the same in percentage terms. So since the breakout, I think, as I said, in 2024, I think it was, that's the move we've seen in gold. If we have a look at previous bull markets for gold, it's, we're only halfway there. We have a look at 7 years, which, a lot of analysts point to as, I guess, an analog for what we're going through now in terms of, the bullying of the Fed and inflation maybe getting out of control and
US dollar going
US dollar going down.
and every word that Donald Trump utters, good for gold.
Yep.
Greenland, Venezuela,
Yeah.
Europe, hang on, whole Europe,
Yeah.
good for gold.
So it's a buy the dip.
Yeah.
It's a buy the dip.
Buy the dip. Okay, PLS has had a great run. Is it still looking viable?
Look, I think short term it's going to come back a bit. Does look a little bit toppy in the short term. This is a daily chart. So I think we looked at these stocks mid last year. So they went through a boss.
Also, I was praying for a lithium
And they did break above the line. And PLS is one I think we've been in and out of a couple of times. We're now in mineral resources. So we've been in and out of mineral resources a couple of times. They're still trending. This curvy line is a 50-day moving average. I think if anybody's holding PLS, maybe use that as your trailing stop as long as it's above that. I think if you're looking to buy PLS, if it starts to close that gap to the 50, then use that weakness to
Are
buy.
you saying it around what? Around $4 or
Maybe around sort of 15, something like that. Okay. And then you could use that line as your initial stop. So if you pay $4.15 for it, and then it drops 10 cents and it's under that blue line, just sell it, take the small loss and move on. But look, it's still trending.
Okay, out of excitement into boredom, Amcor.
Yeah.
Is there any potential here for him?
Look, at the moment, it's trending low. We could see that it peaked actually, what is that, early 2022. So it's, when the rest of the market got excited and I guess our market can't hold two opposing thoughts at the same time. It's part of, if this is boring and now the market's going up, we need to be exciting. If resources are going up, we don't want tape, we want resources. So
women might say this because stock markets are dominated by men and they can only do one thing. I don't know if I get in trouble for that or not, but that's what they probably nasty women might say. But this is looking a little promising. I know I got some of my clients now around this level and I'm happy with the gain, but that's not looking convincing at this point in time.
Yeah, so look, there's the bound trend. Yeah, early signs it might be trying to bottom out.
Yeah,
so one worth keeping an eye on. But yeah, clearly it's not one of the strongest stocks on the board.
No, it's always been pretty boring. So I just got lucky because the price was low. Let's go to Paladin now, another excitement stock.
Yeah, look, I mean, I've been talking up uranium for a couple of years. Our clients are invested. They're not invested in Paladin, even though I've mentioned Paladin on the show. They've got the uranium miners ETF. So that's punching through to all-time highs at the moment in terms of the miners ETF. But
what was the ticker for that one?
URNM.
That's right. You missed that before.
Yeah. So, but Paladin, this is the weekly chiller. We had this sort of pullback here. It's broken that downtrend. It's rallying very strongly. When I have a look at, I think uranium will be the biggest opportunity for this year. The uranium price is about to break out for a variety of reasons, and the overall way that the uranium price is trading, it's very similar to silver about a year ago. So I was telling a lot of people a year ago, silver very long term, what's known as a cup and handle formation. You'll get an explosive move. And it looks like uranium's about to do that. So if you don't want to go for the ETF, then yes, I think you'll do really well out of Paladin. I think you'll be into the $20-something region in the next 3 to 6 months. Looking very good.
Yeah, and it's been a good buy the dip stock, hasn't it? Like you buy it, you win, you lose, but it comes back. So let's go our final one. That I think is it. But have you thrown your pledge?
So I brought this one on. So it is an ETF. It has the code FUEL.
Yeah.
Now this contains the overseas major oil and gas companies. So, Exxon, Chevron.
So if you don't want Woodside and Santos, this gives you, are they in there as well?
No, just the overseas.
Okay.
So the reason why I point this out is, I'm still bullish on all the other commodities, but the precious metals moved first. And we've seen the moves in copper and other base metals.
Yeah.
Now I think this year we're going to see the big moves in energy. So not just uranium, I think coal as well. And I think oil and gas. So the oil and gas sector is a portion of the S&P 500. Used to be about 14%. Now it's about just under 3%. But no one owns the stocks. Everyone hates the sector. I'm sure if you ask 100 people, 100 financial advisors or anyone that should know what they're talking about, what do you think of oil and gas? I think 99 out of 100 say, why would you do that? Don't go there. Very interesting tell in terms of the way oil and gas prices have traded recently is all the issues with Venezuela. So we turn up on Monday, we heard what's happening in Venezuela. Everyone's saying, okay, well, the oil price is going to collapse because Trump's going to take all their oil and flood the market. By the end of the week, the price of oil was up about 2.5%. That's sort of the first tell that we've seen a low in the oil price. You can't incentivize oil companies to provide more supply if you have an oil price that's in the 50s or 60s. It needs to be in the 80s. So we're starting to see a bit of a breakout here in the major oil companies, and I think there's some smart money already sniffing out what's really going to happen this year with the oil price. Have a look at fuel. It might not do anything exciting in the next few days, few weeks, but if you want to set yourself up for a very nice move this year, that's one to wear.
Okay. Of course, you're not giving a tip so much because you don't know the circumstances, but that's one of your informed educational guesses.
I've advised my clients to buy this and we're holding it. So
okay.
thanks out what you will.
Okay, fantastic. Mike Gable, always great to see you. Thanks for joining us.
Thanks, Peter.
Mike Gable from Fairmont Equities. Now, let's catch up with Paul Rickard of the Switzer Report to check in with him on what he thinks is going to be gold, best way of playing gold, and all the other things that are fairly important in this interesting market for 2026. Thanks for joining us, Paul.
Thanks, Peter.
So, look, I've talked to Adam Dawes, I've talked to Mike Gable, and they're all giving the thumbs up to gold despite its unbelievably high prices. What's your analysis of gold?
Yeah, I'm probably in the same boat, Pete. Look, I haven't been a gold bug.
No, you haven't. You turned me off gold
Yeah.
over the years.
The trigger for me in gold was when it broke $4,000 US. That was a few months back. But I think the factors that have driven gold up over the last year are still there today. So,
What are they?
well, it's essentially what I call de-dollarization. Now, I might say that's an original word, but this is there are two parts to this. One is the central banks around the world are probably the biggest influence, who in the 15 to 20 years ago reduced their reserves in gold, got out of gold. They've all been buying gold over the last 3, 4, 5 years. I can't tell you why, Pete, but they have, right? And I guess the more they look at what's happening in America, the more they're thinking about some hard reserves. So I think that's probably part of it, but it's not necessarily what started the move back into gold assets. Then I think you see a lot of institutions as well saying, look, we can't understand what's going on in the US. It's just too big for the rest of the world. We put all this money, we know it's got a huge debt problem. We've got all this money in US Treasury bonds. We need some insurance, right? And I think it's
And they're not AAA anymore, are they?
they're not AAA anymore. So it's all the geopolitical risk and the rest of it. So I think it's a combination of, the central banks probably, with a lot of institutions saying we need to sort of put some money aside to something that's a bit harder. non-US dollar treasury bonds effectively. And then, of course, there's supporting factors that are interest rates are still falling in the US, which is good for the price of gold. And you've got an administration with Trump that wants to lower US dollars. So he was lower the US dollar. That actually means a higher price in for gold.
Yeah.
So all that sort of supports it. So I don't see anything change. In fact, if you look at last weekend and tariff show with Europe, I mean, the whole thing just gets crazier by the minute.
Yeah.
So
It's an excitement machine.
I have to think that we've
Excitement machine.
it's hard to think that world's a
Yeah.
logical place.
And I've got to say, for our financial planning clients, and I've never put them into gold over the years, they've got access to gold in things like X20 because a lot of the smaller miners are in there. But I'm thinking from this point of view that because they've done so well for the last 3 years, I want them to get a bit more defensive. And I like the fact that gold can be defensive, but also has this growth potential at the moment. We might have to get out after a year or two if Donald Trump loses badly in the midterms. This guy, I think, is going to be causing Trumpism for the next three years or so. But the bottom line is gold is looking attractive, Paul. You're a big one because of the currency view to have a hedged version of. So what's the ETF that's good for hedged?
Yeah, so look, there are two hedged. The one that probably is QAU from Beta Shares.
QAU.
Just to look at what happened last year. You can read all about this in my article. But
if you're a subscriber to the Switzer Report.
But for those who went into the unhedged ETFs, and then most of them are unhedged, the return was between 52 and 54%. Not
bad.
Bad, not to be unsneezed of.
Sneezed about.
Sneezed about. Sorry about that.
Sneezed at.
Sneezed at.
Yeah.
But the return from the hedged ETFs was about 64%.
Okay.
So they lost about 10% last year.
Aussie going up, US dollar going down.
Yep, by not being hedged. Now, most of the investment in gold, of course, is unhedged. So that you've got to think about how you hedge. And then the other, so that's point number one. And there are different ways to do that. There's a couple of ETFs. But the other thing is, if you really want to spend
always had gold,
in gold, and I think this is a much higher risk. Gold mining companies will give you a much higher return, but a much higher risk.
Yeah.
So again, just to put the numbers around that, I mentioned the ETF returns of about 54%. The major miners last year, their returns were between 76 and 198%, averaging around 140. So they were double the return of the ETF, and that's because if you think about it, that most of our major gold miners, they have pretty fixed production costs, right? It's sort of paying Australian wages, they've got capital,
right.
Most of their costs are fixed.
They wouldn't have risen by more than 5%, but the commodity rise.
The price doubles, their profit margin goes through the roof.
Yeah.
And of course, the leverage on a gold mine, and that's a producing miner, is many times more greater than you'll get by just owning the physical asset. Conversely, if the price of gold falls over the next couple
They'll be smashed.
they'll be smashed.
Yeah.
So they're for the risk, the thrill seekers,
Yeah.
and you can read about which ones have done better and which ones we like in the Switzer Report.
Okay. Now, one of the things that I talked to Adam Dawes and Mike Gable about is, the collapse of price of great companies like NextDC, Xero, CSL. And his charts aren't giving me a real confidence that we'll see a turning point anytime soon. But the charts can be deceptive, can't they, Paul? To try and pick the bottom.
Yeah, look, I have to be honest and say, Peter, I've never been good at picking bottoms, but someone has to start the turning point, and things don't go down forever. They have been some precipitous falls.
Yeah.
And again, this is why the other thing that drives the gold view a little bit is the world's doing some crazy things out there, right? Suppose we've got a bull market, but like in places like Australia, all our growth stocks have been pummeled. Right?
Yeah.
Which suggests there's a lot of people that are looking at the market and saying, we don't really like what's going on. So I think there's a bit of value to be had. I mean, I think Xero at about 100, maybe 100 doesn't hold it. Maybe it sails through, but I think that's a good sort of price to look at.
And because reporting season is coming up,
Yep.
it's like take the punt before the news almost out in the first.
I would, because, well, I mean, you could be safer and wait for it all, and wait till you get that round.
But the first jump will be a good, big one if it's a good report.
We're not talking about you put half your portfolio into this stuff, right? Like, we're talking about the margin, right? The core, and the same with gold, right? The core stays what it is. They're not putting 50% into gold, right? We're talking about
5% is like not a bad allocation.
and so the same with these sort of things, because they're definitely higher risk, and you don't, you want a nice return, but sometimes it's hard to work out what to do.
But it's lovely to when you have a punt, and like the people who believed in POS a year ago, the people at BHP, and it's what 40, 35, we got down to it, and then we also saw what's another big rebounder of late, Paladin. It was smashed and now it's come back.
You couldn't give lithium stocks away about 3 months ago.
That's right.
And they've trebled in that period of time, right?
Exactly.
And really the commodity has gone up, but it's all the same analysts who are super bearish are now bullish.
Yeah.
Not much really has changed, a bit in China, but like, it's sort of, you've got to be very careful with stuff. And that's what is high risk. I think Xero is a different category because it's an underlying business. It has cash flows.
Yeah, it's profitable.
It's profitable. It knows how to charge. I think the market has been unsure about Xero is its strategy in the US. But Xero, I think NextDC looks all right. WiseTech probably looks all right. Pro Medicus today's been smashed again. Now,
It's tempted.
I am very tempted. I may even get by some Pro Medicus this afternoon. I thought $200 would hold it, and maybe it will. It's about 190. So I looked a few minutes ago at low numbers. I'm really surprised it's this.
Because you have been a stockbroker in your younger, more badly behaved days, Paul, and it's kicked off ComSec as well. A lot of people don't get this, that really good companies can cop it purely because the market now likes resources. And so anyone who's made a lot of money out of NextDC and Xero, they've taken their profit, they've now rolled into resources. There's nothing essentially wrong with these companies apart from the fact that people don't want to buy them.
Yeah. The same people who were ultra bullish on, or ultra bearish on lithium companies 3 months ago, suddenly, look, the market is very fickle. We're all trying to outdo everyone else. Sentiment changes quickly. We all talk about fundamentals, but we're the first people to abandon them. And it's a lot of momentum stuff. So look, you and I were talking about, well, at the start of middle of last year, this was the time to be looking into resources. We're a bit more conservative. It's mainly been the
some people thought we were nutcases.
and suddenly everyone else has switched to resources. And driving that was a fairly simple view that the banks were too expensive. Now the banks are sort of coming back. But it takes time. Like you look pretty stupid for a while.
But I think Paul, that's the important thing. I think good investing starts with you buy quality businesses, you don't worry about the timing so much, and you have patience. And as long as you do that, you might not get the money grows as quickly as you want, but it'll come over time.
I mean, I have never bought at the bottom, and I have never sold at the top. I think anyone who expects they can do that on a consistent basis, you are DREMING.
I've done it once. And I'm going to boast about it. But I haven't done it very often, let me tell you that. All right, so that's Paul Rickard. Thanks for joining us, Paul.
Thanks, Peter.
And you can catch, if you want to know more about what Paul thinks about gold, and you should become a subscriber to the Switzer Report. Thanks, mate.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. Thanks for joining us. That's the show. We'll see you next week. And don't forget, you can get my daily coverage of what's going on in Switzer Daily, switzer.com.au. But if you want to be a subscriber, go to switzerreport.com.au.